Yeah, that's clever. I hadn't seen that intro before. Welcome to Jazz After Dark, everybody. How you doing today? It's been a while. I actually thought, hey, I'll go on a little vacation, get away for a little bit. Nothing could possibly go wrong. And then, banks start failing, the Fed's talking, we got Russian planes coming after us and stuff. My gosh. So I'm in need of a drink here tonight. Huh? How about that? This is actually called Spirit of the Oak by Dark Door Spirits. I liked the idea when I was reading about it because they finish it in oak chips and stowed in oak barrels. Oh, I can't talk. And so I thought we would give this a try here tonight. So welcome to those of you that have no idea what's going on. We're financial advisors here at Jazz Wealth, but this is the After Dark version. So we get to try things a little bit differently here, for better or for worse. So we'll just give that a taste and see what we have. Oh, I can already smell it. It actually kind of smells, it's got a little bit of a wine smell to it. Very much so, actually. But anyways, welcome, and hope you have something to drink and hang out with me here. Just a sampling tonight because I've got a lot of work to do to catch up. That is wild. Whoa, yeah, oak and cherry and fruits and wine. Definitely the grape side of the wine there. No real strong, no real nasty kind of aftertaste. But holy cow, that is wildly different. A lot of dark cherry or something going on. Raisin maybe. Hey, that's not bad. I like that there. 92 proof. Man, I'd give that like a 81. If I had to rank it there, which haven't done that in a while. What's changed in here with the shadows or something? I'll tell you, I don't know what the answer to that is, but I'll tell you what's changed in the banking sector. If you've been looking to get a loan, it's about to get a little harder. So we all know at least the headlines of what happened with the banks. If you're one of our clients, if you want to know specifically what happened with SVB Bank and why that will not cause a problem with the rest of the banking or financial system, I emailed clients 11:30 at night. I don't even remember what night it was. I think it was Saturday night or Sunday night, just to let them know, here's what happened. The headlines were telling you one thing, and of course, the truth was a little bit different. And we can back that up because we could look at SVB's financials. We're actually able to dig through all the data instead of just giving you a headline. Oh no, invest more money at Jazz Wealth because we'll be fine, but they won't. That would not be right. So because of that, what's going to happen? Now, to give this example, let's pretend you're a fine distiller here and you sell your bourbon, right? And something's going on in the bourbon world, and you're like, oh, I don't feel good about that. I worry that Dark Door here. I worry that I won't be able to sell as much of my bourbon as I want to. What are you going to do as a company? You're going to hold back a little cash. The term is usually hoard cash. You might decide, well, let me put a little more money in my savings account because I don't know what might happen with my company. I still want to make this and build my brand, and I want all the success I can get. But if something's happening in the bourbon world, I know that the bigger companies, they're likely going to be fine and be able to continue to grow and establish market share and be basically okay. But me, as whoever these guys are, Dark Door Distillery, I'm going to need that cash to compete because I won't be able to what? Get financing, get liquidity, get all of that stuff that you may need, lines of credit. Well, now that's the example. Now imagine if you're a bank. I'm pretty sure nobody watching this owns or runs a bank, but if you're a bank and you just saw what happened to SVB, you might know as a bank owner, oh, that's not my business. I don't handle my business that way, which was not reckless at all. But I am in the business, and I worry that, maybe people will want to come take their money out of my bank, and it'll be harder to gain trust over time. So therefore, I'm going to hang on to more of the money, the profit, the deposits that we have come in that are willing to stay there. Well, what does that mean for a bank? If a bank hoards cash, it means they're not making loans. It means that they will no longer do a commercial loan, or they will do a single family home purchase loan, an auto loan, a personal loan, a college education loan, because they want to hold the cash. They don't want to lend it out. Depositors were giving them the money and they said, well, we're just thankful to have the money. We're going to hold on to it in case depositors take out money. So that's bad, right? That's the bad part of all of this. That's what's going on. Well, we can actually track that. So let's start with, and I can barely read this, I'll be honest. It's so small on the screen. Bear with me here. Let's start with this. Oh, we got a big title. The percentage of banks reporting an increased willingness, this is like an SAT test, an increased willingness to make a consumer loan. The percentage of banks saying they are willing to or increasing their willingness to make that loan is going down. Therefore, they are less willing, this is horrible, less willing to make a consumer loan. Now, that's one thing. Look over, that's fine. Less banks want to make consumer loans. However, is this an extreme? We're rapidly approaching an extreme. Notice that? This is the COVID low right here. This is the financial crisis low. This is the third lowest we've been. It took COVID and the financial crisis to actually show something lower. This is not good. Banks, in other words, are tightening, hoarding cash, like I was explaining there. And they're saying, we may change that, but for the moment, we're not doing anything. That's not really good there. So now we can actually go a little bit further. I'm just going to go through a few because this is, you get the gist of it. This is the percentage of banks here in the US that are reporting we are going to tighten our standards for non-jumbo loans. And a jumbo loan is a little bit different depending on where you're at, but you get the gist of it. It's a big loan for a mortgage, or it's a small loan relative to where you live and what your limits are. So here we go. We are tightening, more banks are saying, we are tightening our standards for a non-jumbo loan where most people go to get their mortgages, right? It took COVID to show the worst ever in history. That means that banks are saying, oh, we no longer want to make a mortgage loan. We would like to keep the cash instead. That's not good. Let's continue, because you're going to find yourself somewhere in this mix. The percentage of domestic banks reporting tightening of standards for real estate loans that are really meant for multifamily apartments and triplexes and multiplexes and things, right? Basically everybody, right? This is COVID. We're basically at a COVID high. The first thing a bank usually, well, I shouldn't say usually, but the first thing historically banks have done is they say, when we need to keep cash, we're going to stop that multifamily lending first. We don't want to cut off the single family home buyer. That's bread and butter right there. We don't want to cut off someone who's qualified for a personal loan, even though it may be at 12%. If they're still willing to take it and they're qualified, we like that bread and butter. We do not like the risk of someone wanting the money for a commercial loan to go build an apartment building or to purchase an apartment building because prices are inflated. They realize that's a little bit more risky. And so this is actually normal. Don't let the rate of increase here scare you. That's a very volatile number. Anyways, moving on, just a couple more. The percentage of banks reporting tightening standards for consumer loans, but we're not talking about credit cards and auto loans. These are your personal loans. This is, again, something you won't see go too crazy because this is easy money for a bank if you're more than qualified. So that one's actually obviously tightened, but not as bad. Credit card loans, there we go. Oh boy. This is credit cards. This is what we're talking about. The percentage of banks reporting tightening standards for credit cards. Oh my God, same thing. Well, this is the fourth highest, COVID being the highest, financial crisis second, going back to 88, 89 in here for the rest of it. What does tightening mean, by the way? Tightening doesn't mean that they won't do it. Tightening means they make it less attractive for you to want to take the loan. So while they may say no to a commercial multifamily apartment type loan, they may still be willing to say yes to a home loan or a personal loan, but the rate's going to be higher. The spread between what it costs them and what they're willing to loan to you for may be wider. They may require a higher credit score. A lot of lenders right now are saying, we require for you to show us cash equivalents for the first 12 months of the payments, for the first 18 months of the payments. Right? I keep track of the aircraft industry quite a bit. They want 18 months worth of payments. So they're basically saying, yeah, you have a down payment for the home loan or whatever, but we want to see that you have cash in the bank, or, marketable securities is the fancy word that they would use. You get what I'm saying. So that's tightening there. Lastly, we'll do car loans here. The percentage of banks saying we're tightening our standards for car loans. It's getting tough out there. Now, to be fair, this was already increasing, so we knew that this was likely going to get tighter anyways, and a lot of that's due to demand. The demand's been dropping off there, despite what I still see on TV. It's like, we all can look at the data. How can a TV show go on and say the exact opposite of what the current data is? I'm getting grumpy in my old age, but so nonetheless, this was not to be a video about doom and gloom or anything like that. It was meant to show you that if you're looking for a loan, now you may find that it costs a little bit more. We know interest rates went up, but you may find that it's harder for you to qualify, or that the bank actually asks more of you, which is weird because don't they want you to come do business with them? Yeah, but they want you to deposit your cash there. They don't want you to take money from them. They want you to put your money in the bank. That's what they're worried about. And so while that's the case, there's your quick lesson on how when banks decide to hoard their cash, it is much different than if Caterpillar hoards their cash, or if Nvidia hoards their cash, Tesla, etc. You get what I'm saying. It's a different animal, or the bourbon people. Different animal, because that cash usually goes right back out the door. It's called the velocity of money. It usually goes out the door and is lent to people. Oh boy, if they're not going to lend, it's going to be tougher, which means, kind of in a roundabout way, couldn't that slow down the economy a little faster or a little more than expected? Yeah, that's why you see this is such a big deal, to get people to be confident in the banking system. It's what will keep the loans going and the debts being repaid and the deposits being made. That's the, finance 101 or banking 101 lesson for tonight. And I think that's good. I rambled enough. I think that pretty much covers it there. I have nothing else to cover. Do you have any questions for me? This is very good. That is right up my alley, man. Right up my alley. I may have to change my score. I mean, sweet, maybe tea, you get a little tea kind of a taste. That might be coming from the barrel. But anyways, I'll leave you with that. I do appreciate you guys hanging out with us here tonight. Also, Wine and Wealth. If you're one of our clients, I will see you in just about an hour. We're going to go through the positions that we selectively have added to our portfolios with the cash position that we've had. We are, if you don't know, Jazz Wealth, we are selectively adding to our financial position. We've run through every one of them and found out which ones do we want to participate in. If they're basically all a discount right now, how do we know we're keeping our clients' money safe and taking appropriate levels of risk given the discount that's out there? I hope someone's looking after your money like that, where your financial advisor is. I'm not very confident though, but if that is not the case, hopefully you'll check us out at jazzwealth.com and enjoy the rest of your evening. We'll see you clients later, 8 o'clock. All right.